Okay, welcome back everybody to the first episode of Who Charted for 2023. This is Dan Russo, Director of Research here at Potomac. With me, as always, is Drew Wells. So 2 weeks into the new year, some exciting developments early on here if you are bullish or mildly bullish on the market. But you know the drill, Drew. 6 charts, 6 minutes. What do you have?
All right, so this is something that's often imitated but never duplicated. This is a chart that we see, I think, popping up on the Twitter sphere a lot and some other research providers. The chart of S&P 500 bond prices and rolling correlations over multiple time frames. This is something that we really started to hit on back in late 2021, early 2022. So we've been talking about this for a while, potential regime shift between the relationship between equities and fixed income. This is arguably probably one of the most important developments that is occurring in the market right now. And I think a lot of people want to point to the correlation metric being positive, and that's definitely something to pay attention to. But rather, if we're in an environment much like we were in the late 90s, and I'm stealing this from Dan once again, I stole it actually previous on our monthly call on our research product, so credit to him. But I think the persistence really of this relationship is what you want to pay attention to.
All right, we said that there were some interesting developments to kick off 2023, and this is one of them. This is an NYSE 10-day breadth thrust. Some of you will know it as breakaway breadth or breakaway momentum, made famous by Walt Deemer, so credit where credit is due. Essentially what this is you take the 10-day advancers, accumulate them, 10-day decliners, accumulate those, and then take a ratio. And when that ratio goes above 2, that's considered a thrust and potentially the start of a new bull market. Now, it's not something that happens often, maybe about 2 dozen since World War II. So when they do happen, people sit up and take notice. And one of them did happen late last week. What's interesting to me is that as people were talking about it, there was actually a ton of pushback. A lot of people saying, well, did they ever happen when the Fed was raising rates, et cetera? So kind of being dismissed here a little bit, which makes it intriguing to me, in conjunction with some other evidence that we're seeing an interesting start for the bulls in 2023.
All right, we talked about the relationship between equities and fixed income. Obviously, trading together has been on the rolling 3-month correlation. So I think a lot of investors, as that relationship persists, are going to be pushed outside of traditional asset classes, right? Sort of lazy portfolio construction that people have gotten away with for so long is probably might not be the best idea going into this year. So we've been actually doing some work on several liquid alternatives on our research product. So definitely check that out on our Monday note. This is equities relative to multi-strategy alternatives, so kind of a broad-based proxy, if you will. Been in a downtrend really all in 2022 and testing a 200-day moving average from below, on a series of lower highs right there. With momentum unable to break through that 60 range, just kind of stalled some of those prior rallies. So it's interesting to see some people, kind of initially picking up on alternatives. If you have to maintain an allocation to, asset classes in the market at all times, that relationship between equities and fixed income is definitely going to push you outside the normal boxes.
All right, sticking with the relative chart theme, if the breadth thrust is a reason to get excited about stocks, well, the lazy thing to do is to kind of just buy a broad basket of stocks. You could do that, right? Cheap index exposure. It doesn't take much skill to do that. If you're willing to put in a little bit more work and you're trying to generate some alpha and outperform the indexes, you want to pay attention to what's leading, what's lagging. Unfortunately, for large swaths of the market still, because it's still a huge weight, growth continues to underperform value. Take a look at this growth to value chart. This is for large caps. Trading at cycle lows, confirmed by momentum, the RSI becoming oversold, going below 30. Below 50-day moving average, below 200-day moving average. It is hard for me to make the case for growth over value until this ratio begins to reverse higher. Now, we could come into some support in the 2018-2019 consolidation zone, but not there yet. So if you like the breadth thrust and then you want to think about where to be, value over growth.
A lot of doom and gloom in the housing market, particularly some of the big metro areas where you're seeing pretty high velocity and reduction in asking prices and a lot of sort of analogs back to the great financial crisis in 2008. Take a look at home construction stocks here, breaking out of a really long-term resistance level at that 65 zone above a rising 50-day moving average. One of the things that I want to highlight here in this chart, particularly as it relates to the price structure, is that higher low put in place in the quarter 4 really of last year. And we're starting to see that pop up with a lot of breakouts and and new highs and things like that we're seeing on our scans. We're seeing a lot of those higher lows, in Q4, and prices starting to drive higher. So it's kind of interesting to see that data flies in the face of a lot of the doom and gloom that you've seen out there on the financial media. And take a look at relative to the S&P 500, again breaking out a long-term relative resistance to the upside, above a rising 50-day moving average on a series of higher lows. And so, the market and the fundamentals are clearly disagreeing here.
All right, let's talk about a different asset class. Let's talk about bonds, in particular corporate bonds. This one's interesting because it's a big part of our work that we do here. This is the corporate bond ETF, LQD. This is a weekly chart, closing prices only, with bands set around a weekly moving average. So generally speaking, if you get above the upper band, that's a bullish signal. And if you cut below the lower band, that's a bearish signal. You can see the bearish signal came into play in the first quarter of 2022, right? So while we were kind of table pounding bears across the fixed income landscape for most of last year, there was a legitimate reason for it. There was a breakdown on this tested signal. What's interesting to me is now, for the first time since that breakdown, we have an upside move above the upper band here. So something to keep an eye on, right? We don't want to remain dogmatic in our views. We don't want to stay married to narratives. We were table pounding bears last year on fixed income, but we're not going to stay that way if the facts change. And it looks to me like the facts are changing here a little bit, at least in the corporate space. So those are my three this week. And I want to thank everybody for tuning in, the first episode of the new year. Drew, take us home.
Thank y'all for spending some time with us. We certainly appreciate your viewership. If you like this kind of content, you can subscribe on the channel, and we will see you in the next video.
See you soon. Thanks, everyone.